Everyone, just so welcome to the session. And in case Hugh didn't mention it, but I'm sure he has, chat. We want to hear where you're from, what you're working on in the chat over here. And then you go to the right, you'll see the Q&A. That's where you'll drop your questions. Question, it's the best place to see it. Anurag, looks like you've already done that. Fantastic question. And then upvote the ones you like. And if Rajesh has time, you can click and see the popular and go by popular and see what people are liking. And we'll answer those questions. And yeah, Rajesh, we'll let you take it away. Hugh and I will hop off, but we're here if you need.
All right, let me walk through how we think about getting climate right this time. I'll probably spend 15, 20 minutes talking about will it take decades again for climate to take off? Is it real? We'll talk about some of the key learnings we have had from Clean Tech 1.0 and also examples of lessons as to how exactly we are applying it to Climate 2.0 companies. These are some of the most frequently asked questions I've gotten in the past, so I thought I'll put together a few slides to walk through it, but certainly want to make sure we have enough time to answer any questions folks may have as well. First question, a lot of naysayers still in climate. One thing we do want to emphasize before I get into the details, big changes happen faster than predicted. This is a great example of in 1900s. This is New York, Fifth Avenue. There is one car you see and everything around is horse carriages. The same place, Fifth Avenue, New York, 1913, in just 13 years, you can see one horse surrounded by cars. So that's how fast innovation can move, changes can happen. Now, this is not a hypothetical example. I actually went back and looked at to see was Clean Tech 1.0 a failure. And I do think climate is real, it's accelerating. We'll talk about a few examples rather than qualitative discussion. I looked at the same 13 years from 2009 to 2022. Same 13-year period I talked about in the New York Fifth Avenue example. Solar, when we were all doing Clean Tech 1.0 back in 2008, 2009, was a minuscule amount compared to coal. And that's gone from 23 gigawatt to more than 800 gigawatt and up and running. And in many places, it's cost effective if paired with the right amount of grid storage. Fossil fuels, have been replaced or continuing to be replaced by batteries. It was just thousands of vehicles on the road back then. Now it's millions of EVs. And if you take into account hybrid EVs as well, it's like, by some estimates, it's like 25 million EVs, hybrid EVs, and that's accelerating significantly. Meat, dairy, plant proteins wasn't even a category back then, and that was an important one for methane mitigation, overall climate impact when we invested in Impossible Foods back in 2011. And that's a really big market, not just for replacing meat, but dairy and all that stuff. Now, what does this mean for Climate 2.0? We see the same thing happening and things are ramping up, and I'll give you a few examples later. But coal, when we look at it, we're really looking with companies like Commonwealth Fusion, looking at coal boilers. How do you replace those coal boilers with nuclear fusion boilers? It's going to take time, but this is the kind of pace at which innovation needs to happen. Similarly, on fossil fuels, we were all working on biofuels a long time ago, but many of the companies had to pivot. And one of the successful ones we have had is LanzaTech, which is looking at sustainable aviation fuels and aviation. Similarly, fossil fuels are going to be replaced by green hydrogen, green ammonia, and things like shipping. And we have a company called Vertigy working in that area. Cement is another area where we are all used to cement releasing CO2. Cement absorbing CO2 is another big innovation that Forterra is looking on. So the things that happen in Climate 1.0, we see the same thing happening at a fast pace in Climate 2.0. But there are a lot of lessons we have learned, we continue to learn, and that we are working with many of our companies and as we talk about new investments as well. Very high level, talk about the key lessons from 1.0. We like to think big. I'll talk about the 12 sectors we're investing on. We really think about climate entrepreneurs as going after those big areas, leaving the incremental innovation to larger corporations. Larger corporations are extremely good in incremental innovation, whereas startups, entrepreneurs are the right ones to think big. And we really focus on the right sectors. And that's something we think a lot about. Patient capital is something we think a lot about, for our own investment, new investments, and as we talk to a lot of startups, how critical that is. So we don't have climate tourists, whether it's investors or entrepreneurs, and how do you sustain this innovation and continue to build these companies with the right amount of capital? Stage de-risking is something we spend a lot of time on in terms of how do you build these companies to value inflection points, not to valuations. So you're taking the right problem through the seed financing, through the Series A financing, and so on, and what are the kind of steps we take to de-risk it the right way versus taking in too much money, too high evaluation, too early. That sets up, this happened in Clean Tech 1.0 a little bit and has happened in Climate 2.0. So building it right way is extremely critical. And I'll talk about a couple of examples. Chindia price is an important concept. Talk about it. Bankability, building the product to bankability is critical. How do you think about pivots when things go a little bit south and still come out fine and going after a really big market? Team, we really think the team you build is the company you build, and what kind of DNA pool is needed to make these companies successful. Guidance is something we spend a lot of time on. What question you ask which person is a very, very critical decision you have to make every day. There are a lot of people who have jumped into climate, which is great for the sector, things like climate and AI, but it's very important to see what background, what experience do those specific people bring in to help you guide the right way, whether the advisors you take in or the investors you take in or the entrepreneurs you bring into the company. Speaking of think big, I'll touch upon some of these examples so we can talk about how we think of each of these elements. We really believe there'll only be about a dozen investigators that will have the huge impact on climate. There are 4 of these segments of these 12 that we've said are getting great solutions to market. EVs, Tesla led the way. A lot of EV innovations are happening. We have companies like QuantumScape and many others innovating on the battery side of things. Food and ag, companies like Impossible Foods are got the solutions to market. There is a lot happening on sustainable aviation fuels with companies like LanzaJet and many other companies that are not in our portfolio as well are working on these problems. I would put the next bucket in the feasible solutions that are being de-risked today. This would include fusion, geothermal, include the innovations happening around public transit, long duration grid storage, which becomes extremely critical as you think about solar, wind, renewables intermittence. Industrial is another huge segment where there are really good solutions being de-risked in the market, whether it's industrial heat or hydrogen or steel. The final category of high impact solutions where we see a lot of early ideas being tested and a lot of innovations coming on, but very high impact are things around fertilizers, water, DAC, and HVAC. So the reason for walking through is, this is a dozen indicators, give or take a few, but these are the kind of big problems that are worth solving for entrepreneurs to go and big. No matter what you work in climate, it's going to be a 5, 6, 10-year journey to get this commercial product to market if you're starting early. So you might as well bet on the biggest problems you're going to bet your life on to make that impact rather than incremental innovation. Patient capital is something we care a lot about. I'll give you the examples of how we think about patient capital, how we focus on stage de-risking. These are, again, examples of some of our companies that we invested in Climate 1.2, and it took 10 years to maturity. They had to survive to thrive these times, to thrive, and they come out on the other side with products, first of a kind plant, building going beyond the pilot facilities and actually in commercial revenues with many of these cases. But the patient capital, that we're able to pull together with other syndicate partners, that becomes a very critical element to make sure these companies are successful. And in the Climate 2.0, we have been investing heavily in really bold, early, impactful themes where us and a lot of our syndicate partners and entrepreneurs who have gone through the Clean Tech 1.0 journey are able to add value to these companies. We have been investing in fusion, fertilizers, steel, hydrogen, direct air capture, biodegradable plastics, and batteries. And I will walk through a few specific examples of what we learned in Clean Tech 1.0 that's being relevant and valuable as to how these companies think about Climate 2.0 when they build the next set of milestones that they are looking to de-risk. And on that example, I want to talk about the Chindia price. We talk about this. This is an important concept. Like within our investment decisions, we never calculate an IRR or cash on cash or any of those metrics. What we do focus on is the techno-economics, the cost entitlement that a company has in terms of the nth plant that they would make. And the way we like to think about it is, can you meet the Chindia price? In other words, would you develop a technology that has a cost entitlement so you can actually go sell this technology in cost competitive markets like China and India? That's a bar we keep. And Doesn't mean China and India are the first markets, but it's a principle, it's a philosophy of looking at, how do you go down the cost curve fast and not just dependent on subsidies or, just well-developed markets having the ability to take the price premiums. I'll talk to 2 or 3 examples. This is not a pitch on these companies, but really about the very specific example these folks have done and that have allowed them to attract really good investors. Some of them have closed recent rounds and all that stuff. But these are good examples. Fortera is a cement company. The innovation is around absorbing CO2 back into calcium oxide so you can make a cementitious calcium carbonate. Now, this is a huge innovation in terms of how do you make this calcium carbonate cementitious. But what is interesting is how they've coupled it with the right economics. So they are using existing feedstock, calcium carbonate, that the market uses. So they're not taking a risk going after a completely new fancy raw material, which will take a lot of qualification timeline, industry adoption. And at the end of the day, you're putting cement, you're sleeping, in many countries, use cement to build homes, to build commercial plants and all that stuff. So the regulatory hurdle becomes very high. So using existing feedstock helps. Now, their innovation is still can be retrofitted into existing cement plants, which means it's very less capex, the regulatory hurdles are low, and the siting hurdles are very low. So all of these things make a big difference in terms of how fast you can accelerate this technology to market. And on top of it, it's a higher throughput because you're adding 44% of the CO2 back into the calcium oxide, which means it's a high throughput for the cement plants that want to integrate the technology. So this is how we really like to think about it, not just for this company. I'll give you a couple of more examples, but this is something worth thinking about as you build a company in terms of how do I bring the innovation, but at the same time, how do I actually go and capitalize on what is already available in the market? The other aspect to think about, I'll come to another example. Kalex is a solar company. They just raised a good amount of financing from Temasek, Fidelity, and all those folks. But the reason it's worth making another solar investment is actually they coat the perovskite on glass. Now, think about what that innovation means. They can increase the efficiency of a module by 30%, but they don't need to take a risk on the silicon. Their glass coated with perovskite is compatible with First Solar, SunPower, GCLs of the world. So all the existing solar companies can leverage their technology. You don't have to go to a completely new fancy silicon material. You can actually use your existing capex, put a Kalex plant right next to it, get the perovskite coated on glass, and then put it on the silicon cell. So that reduces the adoption barrier in a huge way while improving the efficiency and the cost structure of any of the solar silicon plants today. Third and final example, in the spirit of giving more examples, is Commonwealth fusion. So you could easily think of it as coal and nuclear fusion can never work together. But the way the company thought about it, and we're fully supportive of that approach, and is how do you retrofit existing coal plants, replace the coal boilers in these coal plants with nuclear fusion boilers? Now, think of what that means. That means you can leverage the entire balance of plant in a coal facility today and retrofit that coal plant with these fusion boilers. That means you don't have to come up with completely new capex. Yes, you need a capex for the fusion boiler side of things, but the retrofit, the rest of the plants, it means you're bringing jobs back to the counties that are worried about, losing the workers and the revenue and the tax stream that comes out of those plants. So all of these things make a big difference, particularly in a sector like clean tech, where you have to think about capex upfront, you have to think about siting, you have to think about job creation, all this stuff. So this is just, I was putting it in the concept of the Chindia price, both from a technology entitlement as well as how do you get to market faster, cheaper, and still bring in the innovation you need to bring in. In the interest of time, I'll skip through some of this stuff, but bankability is very critical. That's a very standard term. I mean, many of us who have gone through the solar world know how important it was for solar companies not just to innovate on the technology, but show the bankability. Now, what that means for a climate company today is, as you even think about seed and Series A and Series B, technical milestones you'd want to de-risk, think of your customer as how do you demonstrate the bankability with your first pilot plant, with your first product that you're testing with your customers. And whether it's a material innovation or a process innovation, make sure that addresses the bankability question. And that puts a different mentality on what are the technical milestones you're de-risking. So your customer is not the next set of investors. It's really heading towards kind of how do I make this product bankable? Pivots are extremely critical in climate. We have had companies like LanzaTech. They did not start off with sustainable aviation fuel. But as you develop your portfolio of IP, product development, what markets you want to keep an eye on, it's very important to have people in your journey who can help you with the pivots, the entrepreneurs who can bring into your company, who can think about the pivots if it's ever needed. But building a robust portfolio upfront and being ready to switch is a big deal. One aspect we really like to think about with many of our companies is, if you had additional 5%, 10% capital, what are the other things you would do to think about other markets? So if things go south in your base market, you have the ability to pivot. And unless you develop the optionalities upfront, it becomes difficult to pivot when you run out of cash. Team is the single most important thing that we care about. The team you build is the company you build. So as we think about our seed and Series A checks, where we like to come in and invest, continue to invest over a long period of time, it's very important to think about what the DNA pool you want in the company. It's not necessarily people just from the same industry, because people from an exact industry you are disrupting know what doesn't work. They may not know, how else to do it in a different way. So how you think about the team in a VP of engineering or a CCO, all of that makes a big difference in terms of how you build the company. Guidance, I think I mentioned about it earlier. It's very important to ask the right question to the right person. So because there are a lot of ideas, a lot of feedbacks, a lot of guidance that people give. So even when you bring in advisors, have our company's portfolio or new companies that we're evaluating, when we ask them to ask the key questions to the right people, that makes a critical impact on how the companies think about their future roadmap. So just some final observations before we jump into the questions. If people tell you startups fail clean tech 1.0, I personally believe, and many of the folks who are co-invested with this 1.0 do think it's not the startups that fail clean tech 1.0, it's the investors. So we just need to make sure it doesn't happen this time. Government funding matters a lot. So make sure you're on top of, ARPA-E mattered a lot in 1.0. I know many of you are working with the IRA. DOE loan has been a fantastic supporter. And some of you may be joining from Europe, and there is a lot of innovations going, a lot of incentives going on in a lot of the countries. So even if you're a seed or Series A company, keep an eye on, how do you tap into the finding? What do you learn? Another critical one is 12 to 15 significant problem matters versus 50 plus trivial ones. So make sure you're targeting the biggest problems that will make the highest impact. And that goes with radical and not incremental innovation. This is a mantra we do at KV. I learned it from my previous company. It's really important to not just think big, but test small, fail fast, learn quick. So that's where iterating to reduce the risk versus raising a lot of money and scaling too early becomes an expensive failure. So there is a method to the madness in terms of how do you build a company to value to the next round versus just valuation. And so there's a way to do it right. And there is a lot, we continue to learn. We'll all still make mistakes, but hopefully not the same mistakes. So you can do all of this. This will be hopefully my last slide. You can do all of this. But I have been in multiple industries where, despite the best efforts, money coming in, all of that stuff, the technologies have shifted to China. This happened in telecom. I was in Bell Labs. People used to joke about Huawei, and today Bell Labs and Lucent doesn't exist the way it used to. I've been at Applied Ventures, where we invested a lot in semiconductors, solar, batteries, and markets like solar and batteries clearly went to China. Now I'm glad they're all coming back with the IRA. Hundreds of gigawatt have been announced in batteries, but that's for one industry. And DOE is doing a fantastic job trying to bring back other industries, but it's for the entrepreneurs as well. How do we work together with the entrepreneurs, with the right investors, to make sure we are building these industries where the innovation is happening, where we're building these things in US. Manufacturing matters, and it's going to take a village to build these companies. And ARPA-E, DOE, government policies, investors, we have a lot of the really good co-investors that we work with, and people who have been patient over a long period of time. All of us play a critical role. It's important to get it right this time. Can't let the opportunity go. Hopefully that gives you a flavor. Want to make sure we have at least a few minutes to answer any question you folks have.
Awesome talk. Thank you, Rajesh. I think we have time for one or two questions. So just going through the list here. So from Mike Brozowski, do you find your ROI horizon is longer than other VCs funding software products? What milestones or gates do you expect of hard tech climate companies? It's a great question.
Yeah, so the climate companies that I showed you that have come out on the other side of the tunnel, light at the end of the tunnel, have been through a 10, 12-year journey. And we've continued to invest in those companies. We see the same time horizon for the companies we are investing in. Going back to the ROI question, it's important to have the right investment vehicle to do it. So we have a $400 million seed fund, so we can write $2 to $8 million checks for seed or pre-Series A companies. We have a $1 billion main fund, so we can write $5 to $30 million checks. We have a later stage fund, so we can write $50 to $75 million checks. So having that kind of structure, and we raise these investment vehicles every 2.5 years, that helps in building these companies, driving the patient capital, making sure we can sustainably invest in the companies.
Okay, great. And then I think we have time for just one or two more. So from Marcus Lehman, another great question specific to deep tech. For pre-revenue startups, how much do you rely on quantifiable metrics, vs intuition when investing?
Many of the examples I gave you, the pre-seed companies, Impossible Foods was started with Pat Brown coming over and saying, this is a great idea. We want to, go change the world in a big way working on this. So there was no pre-revenue, there was no product developed, there was no team over there. So we do this a lot more than you would think. So it's our key question is it going to be the highest impact area? Does this team have the ability to pull together the most differentiated technology IP? Those are the things we really care about.
Listen, I'm just looking for a question that can be answered in the minute or so we have left. I think maybe one for the early career starters from Anurag Sharma. The first question we had: how to get into climate tech from scratch? Anurag is a recent CS grad in the context, of a job seeker's perspective. What's your advice there?
Look, there were not a lot of climate tech folks 3-4 years ago, and some of the other VCs I mentioned, if you go to a conference and say you're working on climate tech, people would say, go get a dog or go get a job. So there's not a lot of people even 4 or 5 years ago working on climate. We're grateful, thankful that many entrepreneurs have come in from other industries, people who are passionate about making a difference, and that's very, very critical. We care a lot about bringing people from other industries who have scaled up or who have experience and expertise in other industries, and that's very critical. We really think about if experts are experts in the world of the past, they don't necessarily know how to build the future. So a lot of the companies that we have invested in have been founders who have come with brilliant ideas to disrupt a completely new industry. And that makes a big difference in terms of coming up with fresh ideas. So yes, if you're, computer science and other industries do come over, there is a lot of innovations around batteries, how ML and AI are going to be helpful in designing the next generation of batteries. Though that fresh thinking is extremely critical. So we do want people from other industries, not just people who have been in the energy industry.
Rajesh, thank you so much. That was an incredible talk, and thank you for answering some quite tricky questions in not much time. Thank you, everyone. I think we're going to wrap up the session here, and please continue to enjoy the rest of the summit. Thank you again.
The rest of the session. Thank you.